Welcome to Talk Tickers. Today, we're digging into a really interesting one, Hudson Pacific Properties, ticker HPP, and their second quarter results for 2025. And let me tell you, things are not always what they seem. So get this. On paper, HPP's quarter looked pretty rough. A miss on funds from operations, a miss on revenue. But the market? It did the complete opposite, sending the stock soaring almost 7%. So what on earth is going on here? What did investors see that the headlines missed? Well, that's the paradox we're going to unravel right now. Okay, so to really get to the bottom of this, we've got to start with the hard numbers. You know, what the official report said versus what everyone on Wall Street was actually expecting. And yeah, the numbers were undeniably soft. Let's start with adjusted funds from operations, or FFO. That's a super important metric for any REIT. It came in at a 3-cent loss per share when analysts were looking for a 2-cent gain. Ouch! Revenue also came up short, down almost 13% from last year. This was all the noise, the bad news that hit the wires first. But then, this happened. The market just shrugged it all off and sent the stock up over 6.5%. And that tells you everything, right? It says investors looked right past the rearview mirror and started buying into the story management was selling about the road ahead. So what was that story? Well, on the earnings call, management did a masterful job of separating the important signal from all that negative noise. They basically built a whole new narrative for investors, and it was built on two really powerful ideas. Pillar number one was all about building a financial fortress. Seriously, they went on the offensive. They paid back $465 million in debt, taking care of maturities that weren't even due for years. Then they raised almost $700 million in equity just to completely wipe out their credit facility balance. And right after that, they made that credit line even bigger for future needs. These were some seriously aggressive moves to de-risk the company. And what does all that work get you? This, a cool $1 billion in total liquidity. For anyone worried about the shaky office real estate market, that number is like a giant sigh of relief. It's a signal of pure stability and gives the company a very, very long runway to get their turnaround plan done. So, with the balance sheet totally locked down, management moved on to pillar number two, the growth story. They painted this really clear picture of where future demand is going to come from. Half of it, they say, is from AI and tech leasing. Another 30% is from the big recovery they're seeing in their studio business now that Hollywood is back to work. And you know what? They didn't just talk. They brought the receipts. Their leasing pipeline is now sitting at over 2 million square feet. But here's the real kicker. Look at the share of property tours coming from tech tenants. It exploded from 35% to 53%. That's your proof that this AI demand story is actually happening. At the same time, the studio business is getting back on its feet, with occupancy firming up around 75%. These are the green shoots investors wanted to see. And then the CEO, Victor Coleman, just came out and said it. No mincing words. He said, "We have clearly bottomed out in every market we're in. Portfolio stabilization is close." For investors, hearing that kind of confidence, that message of hitting an inflection point, well, that's exactly what they were listening for. Now, for the very next quarter, their guidance is, well, it's pretty modest, just 1 to 5 cents per share in FFO. But that's smart. It sets a really low, achievable bar, which lets them focus on the big strategic plan instead of worrying about tiny short-term earnings beats. Okay, so that's the story of Q2 and how the narrative got completely flipped. But you know the market, it's always about what's next. So what are the key things we need to be watching for on the next earnings call? And how does this all roll up into our official rating? All right, heading into Q3, here's your checklist. Number one is execution. They have to start converting that big 2 million square foot pipeline into actual signed leases. And what we'd really love to see, the thing that would prove the whole thesis, is a major lease signing from a big AI company. Beyond that, we're watching to see if studio use keeps climbing and if they sell off any more non-essential buildings. So, when you put all of this together, what's our take? We're calling our sentiment cautiously constructive. It perfectly describes the situation, right? You have to be cautious and admit the current numbers are still weak, but you have to weigh that against the fantastic strategic moves on the balance sheet and those really promising green shoots we're seeing in the leasing demand. And that leads us directly to our official rating for HPP, Market Perform. Look, the potential upside here is significant, especially with their unique focus on AI tenants and that repaired balance sheet. But you have to balance that against the risk that they don't execute and the fact that the entire office sector still has some major headwinds. And finally, let's turn all this analysis into something a little more actionable. For your consideration, here's how you might think about trading this whole narrative.
So, how do you actually play this?
Well, one plausible approach is what's called a pairs trade. The idea is you'd go long on HPS stock, but at the same time, you'd take a short position in a broader office REIT ETF, one that doesn't have HPS tech focus. This way, you're isolating your bet. You're not just betting on the entire office market recovering. No, you're making a very specific bet that Hudson Pacific's unique exposure to that West Coast AI demand is going to help it dramatically outperform its more generic competitors. Ultimately, HPP's quarter is a fascinating case study in how a smart, forward-looking story can completely overpower a weak set of numbers. The big takeaway here is that in this market, a strong balance sheet and a credible growth narrative can mean so much more than what happened last quarter. That's our analysis from here at Talk Tickers. This is not financial advice.